In this video, we will be learning about our second method of depreciation, and that is reducing balance method. Now, this method is also called diminishing balance method, which also means the same thing, that is reducing. Now, why it is called reducing or diminishing balance method is because the depreciation calculated on a particular non-current asset in a certain year using reducing balance method is less than the depreciation calculated in the previous year. This means that every year the depreciation calculated using reducing balance method on that non-current asset keeps on decreasing. That is why there is a declining depreciation expense with each accounting year, right? You remember in straight line method we learned that the depreciation expense remains same every year, right, because it was calculated on cost. But in this method we are learning that with every passing year, with every accounting year, the depreciation expense keeps on reducing. Now you might be wondering that how is this possible, right? Why the depreciation expense is reducing? This is because that every year depreciation is calculated on the net book value of your non-current asset. Right, you remember when we were doing the examples of straight line method, we saw over there that since the accumulated depreciation is increasing every year, our net book value keeps on decreasing. So, that is why since the net book value is decreasing, your depreciation expense will also reduce, because depreciation calculated under reducing balance method is calculated on the net book value of the non-current asset. Now, let us understand that how do we calculate depreciation under reducing balance method. So, in the first year, since there is no accumulated depreciation, the depreciation rate given to us in the question will be applied on the cost of the non-current asset. For instance, the cost is $8,000 and the company policy is to apply depreciation of 25% using reducing balance method. So, this percentage rate will be applied on the cost, but in the first year only, since there is no accumulated depreciation. Then from year 2 and onwards, the depreciation rate will be applied on the net book value. And how do we calculate net book value? That is cost less accumulated depreciation. Right, a very simple and easy formula. You just have to remember that from year 2, the depreciation rate will be applied on the net book value. Right. Now, let us understand this through a very simple example. The question says a machine costs $23,000. So, this is what the cost is given to us, $23,000. Further says that it is to be depreciated at the rate of 35% using reducing balance method. Okay. Now, the rate is given to us and the depreciation method is reducing balance method. The question is calculate the depreciation charge till year 4. So, till 4 years we have to calculate depreciation, and it also says that the net book value at the end of year 4. Okay. Right. So, we have the formula, right. In first year depreciation rate will be applied on the cost, then from year 2 it will be applied on the net book value. So, let us begin. We will be following the vertical format method in order to calculate depreciation. So, the cost is $23,000. What is the depreciation rate? It is 35%. Now, year 1 cost is $23,000. Depreciation of year 1 will be calculated by multiplying $23,000 with 35%, and that would give us a value of 8,050. Now, I will subtract this depreciation from the cost so that I arrive at the net book value of 14,950. That this is the net book value at the end of year 1. Now I am in year 2 and again I have to apply depreciation at the end of the year. So, how will I apply depreciation now? Not on this cost, no, but on this net book value, right. So, 14,950 multiplied by 35% will give me a value of 5232.5 it is. So, you just round it off 5233. Okay. Now, we will subtract this depreciation from the net book value. Okay. So, that we arrive at the net book value at the end of the year 2, and that would be 9717. Can you see over here that the net book value is 14,950 in year 1 and it is 9717 in year 2. So, it is decreasing. Now, since the net book value is decreasing, you can also see that the depreciation expense is also decreasing, because year by year it is being applied on a lower value. In year 1 the depreciation expense was 8,050, in year 2 it is 5,233. Now, let us move to year 3. In year 3, we will be applying the depreciation, that is 35% on again the net book value of 9717, and that would be 3400, right? It's 3400.95, so let's just keep it 3401. Now, the net book value at the end of year 3 would be 9717 less 3401, it would be 6316. Now we are standing in year 4. So, now again depreciation would be 6316 multiplied by 35%, and that would be 2211. So, the net book value at the end of year 4 will be 4105, right. The requirement was to calculate depreciation till year 4 and the net book value till the end of at the end of year 4, right. Now, let us see that what we studied over here, is it correct or not, and that was that it is there is a declining depreciation expense with each accounting year if we are following the reducing balance method. So, as you can see, in first year it is 80-50, second year it is 52-33 decreasing, third year 34-01, and in fourth year 22-11, and for further future years it will keep on decreasing till it reaches 0, right. So, in reducing balance method, depreciation is applied on the net book value of the non-current asset, and you can see that the depreciation expense keeps on decreasing. Of course, if there are additions to the non-current asset and then we are applying the rate on the accumulated value of the non-current asset, then it will be different, and that we will be learning about in the future videos as well. Now, let us understand that why do businesses use reducing balance method and on what sort of assets. So, reducing or diminishing balance method is usually used on those assets that are expected to give more benefits in the early years and less benefits in the later years. So, if there are certain assets that are likely to give more benefits in the initial years of their useful life, let us say that they are more productive, they are more efficient, or they are more functional in their in the initial years of their useful life, then of course we should use the reducing balance method of depreciation, because it provides more depreciation in the initial years and less depreciation in the later years. Now, the few famous examples of those non-current assets would be motor vehicles, plant and equipment, computers, printers, etc. Now, since these assets are more functional, they are being used more in the initial years of their useful life. So, that is why using reducing balance method would make more sense, right. Now, since they are being used more, they are benefiting the business more. The business is earning more revenue because of such use, because of more use of those non-current assets. So, it would make more sense to use that depreciation method, which will provide a similar expense against that use or against that benefit of the non-current asset. In another way, you can also understand this, that as the running costs of the non-current assets, let us say repairs and maintenance, renewals, fuel expenditures, they increase with the age of non-current asset, right. So, there are fewer repairs, maintenance charges, less fuel consumption in the initial years of the non-current asset, as it is a new non-current asset. So, but it keeps on increasing with every passing year. So, to balance out the expenses, a higher amount of depreciation is charged in the early years and less depreciation is charged in the later years for that non-current asset. So, this means that in the early years there will be higher depreciation cost, but there will be lower maintenance charges or lower running costs of that non-current asset, right. This will balance out the expenses being recorded against the use of that non-current asset. And in the later years there will be lower depreciation cost, because it will keep on decreasing if you are following reducing balance method, but there will be higher maintenance charges. Recording higher maintenance charges during the later years of the use of that non-current asset is fine, right. This is good, this should be recorded, but we cannot record higher depreciation in the later years, because the business won't be using that asset, or the business or the asset will not be that much functional, or it won't be that much productive in the later years. So charging a reduced depreciation amount would balance out the expense. So this is all about reducing balance method of depreciation. What you need to remember about this method is that it is applied on the net book value of the non-current asset. In the first year, the rate is applied on the cost, but with every passing year, it is applied on the net book value. The depreciation expense keeps on decreasing with every passing year. That is why it is called a diminishing or reducing balance method.